Hello traders, this is Blake Morrow with Forex Analytics, and you're listening to the week ahead video for August 13th, 2023. Wow, we're in the middle of August. Summer doldrums are here, but that doesn't mean that we're not getting any volatility, because we sure are. Although next week might be a fairly light week, you would think, but there's a lot of key events that can move the market. So we're going to get right into that here in just a second. What I want to say though is if you haven't checked out Forex Analytics, make sure you do so. It's only $1 for 10 days, and then you get the platform, you get inside of our community. We have probably one of the most active trading communities out there. And with the platform and with the mobile app, you've got all of these great tools and available to you, all of these, all this analysis on 30 different instruments, chat rooms. Make sure you check it out. It's one of the most active communities out there. Okay, let's get into the charts. And instead of going into the live charts into Forex Analytics, I'm actually going to do it on the full screen so you guys can see it a little bit better. Plus, I keep the drawings here every week so you can see exactly what I'm doing every week, and then I can, just revamp everything. And this is actually going to be one of those weeks that I think we're going to take a look at some. You can look at a longer term chart or a daily chart, but more importantly, I want us to take a look at some of the longer term trends. And that means we're going to zoom out a little bit just to get a bigger view of and a more longer term view of some of these currencies. So let's start off with talking about the US dollar Japanese yen. And the reason why I need to do that is because we held the Gartley, we reversed right at the end of the week last week, but all week this week we've moved higher because the dollar index just in general has been moving higher. Now, a lot of that is attributed to the rally that we've seen in yields. So we've seen yields come up towards their highs, and the 10-year yield and the US dollar Japanese yen follow in a very similar correlation. You can see them right here. Now, the reason why this is so important is that we're getting up towards 145, and if we think about like the completion area of a butterfly pattern, that could actually take us probably around here for a move higher if we actually break higher above 145. Now, there's a lot of resistance up here, but there's a bigger issue at hand, and that is that the BOJ, the Ministry of Finance, you can see that when they intervened last time, we were up at 145, and so everybody's probably a little nervous. But if we don't hear anything from the BOJ or the Ministry of Finance this week as we probe around the 145 level, that's going to encourage the market to continue to buy the dollar, especially against the yen, especially if yields continue to rise. So watch the dollar yen. I think it's very important around these levels, and this is where the Ministry of Finance or the Bank of Japan could actually do a quick rug pull, and then next thing you know, you see a big quick move lower. So just keep in mind, if you are trading on the long side and you're like, I am targeting 150, keep your stops tight and be prepared. There could be some slippage in the event something like that does happen. As far as Japan goes, and just discussing the US dollar Japanese yen, there's no huge economic data coming out of Japan this week. So I think everybody's just going to be watching looking at the headlines, listening for headlines and anything to come out from the BOJ or the Ministry of Finance. Okay, so that's one thing I wanted to talk about just to kick us off, because the US dollar Japanese yen right now looks bullish. But you know what else looks bullish? The dollar, as I was just saying, and let me find the dollar index. I've got a couple of charts here to show you. So if you look at the dollar index, we are probing the highs from last week or the last couple of weeks. And you'll notice on Thursday, we created a hammer or a pin bar, and that just propelled the market higher going into Friday following the CPI and the producer prices. So what's the risk here as far as the dollar goes? Well, if you look longer term, the dollar, if we clear the 200-day moving average and also this channel resistance, very loose channel resistance, I've been calling it around 103.70. That's going to open up the door for some further dollar gains. One of the things, and we'll go through the calendar of all the events that are happening this week. And like I said, this week, you may think it's going to be a light summer week. There's a lot of events that can move the market. But I wanted to just point out that if you look at the CFTC data, which was brought to my attention a few weeks ago, that I should really be looking at it, especially right now, the market's still long of euros or short dollars. And that positioning hasn't really changed much. So therefore, what could really entice dollar squeezing could be a multitude of a couple things. A position squeeze, or you could see an unwind of dollar short positions. Technically, if we get above the 200-day moving average, that could spur some of that activity. Also, if the dollar continues to rally on the heels of equity markets looking a little weaker as we head into the final weeks of summer, which we'll get into a little bit later, that could entice a little bit more or encourage a little bit more dollar buying as people look for, the dollar to become a safe haven type of currency. Something just to keep in mind is the dollar index. Even though we completed a nice bull flag pattern, as you all know, over the last month, we've been talking about that. Even though we completed it, we're not giving up gains. And actually, that's a bullish wedge. You can see higher lows and consistent highs. That's a bullish wedge. That means there's a higher probability at this point. There's a higher probability of an upside break than a downside break. So maybe 65, 70% chance of an upside break, 35, 30% chance of a downside break. And so, like I said, it's tilted right now to more of an upside break at this point. And I would have told you that last week as well. And I did, actually, if you listen to the free shows that we do every day. Speaking of which, if you haven't listened to those shows, make sure you do listen to them every day. If you're trading in the European hours, you could be in Asia, trading the tail end of the Asian market into European hours. Listen to the Flow Show with Ryan Littlestone, Stelios Contigoulas, and K-Man. That show is on every single trading day. And then plus you'll catch myself and the rest of the team at the Face Show every day, every trading day, Monday through Friday. So those are both free for anybody to listen to. So if you want always my updated commentary, same with the rest of the team, listen there. Okay, let's continue on. Going right into Monday is going to be a pretty light day. Sunday, Monday, there's not a whole lot going on, but you have to get into Monday night here in North America, or which would be actually Tuesday morning in Australia. I know everybody's watching the Women's World Cup, and congratulations to Australia for advancing. Their women's team looks great. Same with England. Same with those of you in England. I have a feeling they're going to be meeting up somewhere here very soon. I haven't looked at the brackets, but they both look really strong. All right, so going back into the markets, Tuesday night, or Monday night, Tuesday morning, we have the Australian Wage Price Index, monetary policy meeting minutes, and also out of China, we're going to have industrial production. So there's a lot that could actually move the needle in Australia. Now, I told you I want to take a little bit longer term view of the Aussie. This is the scary thing about the Aussie dollar. If you look at this chart and just kind of glance at it, eyeball it, you're going to say that is a triangle pattern. And a triangle pattern tends to go in the direction of the overarching trend. So what is the overarching trend here? I'm zoomed out as far as I can go. The overarching trend is from left to right, it's moving down. So there's a higher probability of us breaking to the downside. Now, I know you're like, wow, if we, break this trend line here, that could spell trouble. Yeah, that's 64 cents, guys. That's where I think the rubber meets the road. Now, we had discussed last week, if you don't recall, that we have a double top. So a double top extension takes us well below 64 cents. So here's the thing. If we break down, could we very easily trade down to 63 cents? Could we very easily test the 61.50? We sure could. Is this going to be the week that cracks or breaks the Aussie to the downside? I don't know. It's the summer, and like I said, we have Aussie wage data coming out, monetary policy meeting minutes coming out. I don't know if that's going to crack the Aussie lower, but risk aversion could. So, and there's not a lot of liquidity this time of the year, so there's less people to stand in the way of it moving lower. Therefore, the volatility could increase. Therefore, you have to keep an open mind here. So that's the Aussie. Something else that's happening on Tuesday morning, since we were just talking about Monday night or Tuesday morning in Australia, but Tuesday early morning, We're going to have the UK claimant count change, or basically some jobless claims is what we call it here in the US. Also out of the UK, we have average earnings index. You know, especially that's going to be watched fairly carefully because the CPI data came in, or excuse me, not the CPI, the GDP data came in stronger out of the UK this week. And that was something that that I actually was thinking it was going to be a little bit lower, but it wasn't. And let me get rid of my picture here. What you're going to notice is if you zoom in to the Kiwi, that strong data, that GDP data, spiked us to 128, or the underside of this channel trend line. We couldn't close back above the 50 DMA. That puts the risk back to the downside. Now, if we're outside of this channel, and think about this for a second. We've been trading outside of this channel. This one right here, we've been trading outside of that channel literally for like a week and a half. And it hasn't been able to go up. So if it hasn't been able to go up, the risk starts to tilt to the downside that we can trade below the 50 DMA towards the 200 DMA, which is at 123.65. Now, remember, we do have UK data this week. That's not the only UK data because on Wednesday morning, we have inflation data out of the UK. Now, that's going to be very, very, very carefully watched as we go into this week. So not only do we have some jobs data, you know, and average earnings index, which is going to factor into CPI. We actually have CPI on Wednesday morning. So all of that could be a market mover for the cable this week. So don't let this one fall off your radar. Okay. All right. So continuing on with Tuesday, you know, some parts of Europe, I think in France and maybe in Italy, correct me if I'm wrong. Some of Europe's going to be closed for Assumption Day. We also, Tuesday morning, we have German ZEW numbers. So I actually should probably just take a look at the euro really quick. And with that, and just, you know, looking at the euro, again, let's think about like the long-term trend here in the euro. It's lower, right? One of the big risks of the euro is we could not climb back above the 618 retracement, as we noted a couple of weeks ago. Just you have to go back to the week ahead videos a couple of weeks ago. Big resistance at you know, the 112.80, I think is what the number was. We couldn't get above it, and because we're failing up here, you know, we get much below this 50 DMA. Why couldn't we test the 200 DMA again? Also, if you haven't seen this, and I should probably draw this because if you listen to our daily shows, you already know this. This is a channel, right? So if you think about it, why couldn't we test the channel, the bottom of the channel, which is near the 200-day moving average? So it seems like to me, there's a trap door here, especially if the dollar starts to gain strength. Why could the dollar gain strength? Well, we talked about it just at the very beginning. You know, maybe some risk aversion, dollar starts to come under pressure, yields continue to rise, the dollar comes under pressure, the euro may eventually buckle. So think about the 50-day to the 200 DMA. I have a feeling in the next couple of weeks, we will be talking about this support level in the euro dollar in the next couple of weeks. And when we do, that may be a great opportunity to be on the long side for those of you that think the euro's going to 120 or 130 in the months ahead. So we're going to obviously revisit that and see what's happening. You know, it's always interesting. I can sit here and go, you know, that's a key level. And some of you are going to go, well, Blake, why don't you just buy it when we get to that key level? That's obviously a possibility, but you don't know what's happening at that point until we get there. You know, if the euro is dropping because, you know, it looks like growth prospects have completely deteriorated and every ECB central banker is talking dovish, and it looks like we're going to unwind all of these rate hikes that we've had this year, and we're going to go into reverse with the ECB. If that's the reason why the euro is trading at 10 or the 200-day moving average or 108 or whatever the number might be, I might second guess buying the euro at those levels. So again, you know, I notice these, or we as traders, we notice and we take notes of where these key levels are at and where we'd want to participate. But whether or not we want to participate when we get there really has more to do with the rate of change, how quickly we got there, why we got there, and would it validate us bouncing from current levels because of those reasons. So we'll note them. And as you know, the 200-day moving average is going to be key support. Whether I decide or whether we decide that we want to be long down there really is going to have more to do with why we're there and how long it took us to get there. So Anyway, I just wanted to make that point clear. All right, so going into continuing into Tuesday, let's take a look at the Canadian because we have Canadian CPI. Now, you guys know I'm very bullish and I'm long the dollar Canadian. Thought we'd test the 200-day moving average. Remember last week? Go to last week's week ahead video. If you haven't done that, make sure you do so. And you know, while I'm saying it, if you weren't able to take advantage of the dollar Canadian rally this week, and you didn't do it in a big way, well, make sure you check out the trader funding program. We actually had traders that qualified to trade our capital this week, and it all fell on that that day. If my recollection serves me correctly, the most passes we got was that day that the dollar Canadian ripped to the 200-day moving average, which leads me to believe that maybe there were some traders out there that were long the dollar Canadian, and now they're not only trading our capital, but they're trading either a $25,000 account, $50,000 account, $250,000 account, $1 million account. If you don't have access to this type of capital, check out the trader funding program. There's a link down below. And then this way you can see if this program's right for you, because not only do you get to take an assessment and see if you can qualify to trade our money, but also in the same time, you'll be included in the Forex analytics community. And that's where you're going to be in the chat rooms with me, other traders from our community, staff members from Forex Analytics, because if you're going to trade our capital, we want you to be in our community, being able to communicate with us, any questions that you might have. So check out the trader funding program. Okay, back to the dollar Canadian. So here we are on the dollar Canadian, and the question that we have right now is, can this rally continue? Well, we have Canadian CPI on Tuesday. If that number comes in below expectations, now you just saw what happened in US. Now, the US unwound that move, like, you know, CPI came in weaker and the dollar was bought up anyway, but I don't think that's going to be the same situation for Canada. If Canada's inflation continues to moderate, we see disinflationary pressures, there's a risk that the dollar Canadian could break 135, the highs from last week, and continue on towards to eventually hitting channel resistance, which will be way up here at 136, 137. But what you'll notice if you go longer term, this Canadian is in a range situation, and you could actually argue that we are in a long-term bullish trend. So why couldn't we just continue to resume that trend and head up towards 140? You know, in the grand scheme of things. So you look at the dollar Canadian, we pivoted off channel support, which many of you were long with myself and continue to be long as a result. But the question I ask now is, can this continue? And with inflation data coming out this week on Tuesday out of Canada, the answer to that question is sure, why not? You know, why can't we resume? Because now we've consolidated our gains. We spent a week consolidating these gains, and if anybody's short, they're thinking, I don't know if I want to be short if we start breaking above 135, right? You got to think about what the traders are thinking on the that not are in your shoes, not you, but think about the traders that are trading on the other side of you. How do they feel? Like if you're shorting the dollar Canadian because it hit the 200-day moving average and it closed at the 200-day moving average and it hasn't dropped below 134 this week, or buyers emerged as it dropped through 124, you got to be thinking, if you're them, you're going, yeah, I don't know if I really want to be short because it's not dipping and every dip is being bought. So if it gets above 135, I think I need to sever my loss and instill good risk management, right? If you're on the other side of that trade. So just think about that the next time you're in a position. What are the traders doing on the other side of the market? And how are they thinking? All right. On Tuesday, we have U.S. retail sales and Empire State Manufacturing. That's some of the big, releases. We also have the FOMC meeting minutes that will be released on Wednesday. Yeah, that's something else that we need to pay attention to. But, speaking of Tuesday night or Wednesday, we're going to have the RBNZ rate decision. Now, here's the thing about the Kiwi. We completed the bear flag pattern last week, It finally completed actually on Thursday. On Thursday, if you're part of the Forex analytics community, here, let me just show you here. And you read the analysis on the Kiwi on Thursday, on the 10th. The bear flag pattern did complete today, but a move to the 59.85 level cannot be ruled out. That was on the 10th. Okay. So on Friday, the 11th, we broke or tested, you could say, the 59.85 support. So here's the thing about the Kiwi dollar. Look at it. I mean, just look. This, to me, looks like a very big trap door set for the bulls, right? I mean, think about that for a second. If you're bullish and you're like, okay, I'm just playing the range. If we get much below 59.80, 59.75, I mean, it's going to open up this trapdoor lower. Now, naturally what I'd want to do is I want to see where the fib levels, because the 618 is pretty close. It's down at 59, but think about that, like double top, breakdown. If we extend this entire range, we do a range, it's just a simple range extension, that takes us towards 55.75 over the course of the next several weeks or months ahead. Now, what could really kick that off? Well, what could kick it off is this week. We have the RBNZ, and the market is expecting, that they stay unchanged. But how about if they hit the market with some really dovish comments like, basically, we're done, we're finished. Inflation seems to be, under control, and we're going to be dealing with China's disinflationary pressures more than the West's inflationary pressures. We've got China to deal with, and if that's the case, what happens to the Kiwi? Now, again, the RBNZ is expected to keep rates unchanged, but a lot of the market's actually expecting them to be a little bit more hawkish. But how about if that doesn't happen? That could send the Kiwi into a tailspin. So that's something that we need to be watching. Actually, on Tuesday night, Wednesday. Talking about Wednesday, I know we mentioned it just a second ago. We have the UK inflation data. We have U.S. building permits. We also have FOMC meeting minutes on Wednesday. So again, I think the pairs that you need to be watching. Obviously, you got to be, during the meeting minutes, is you're going to be watching the dollar and what the dollar is doing across the board. And I think the dollar right now is moving pretty universally across the board, even against the yen. Now, as I mentioned earlier, we got to watch the Ministry of Finance and the Bank of Japan, but watch the dollar index. The risk, I think, right now is that we continue to break higher towards the 200-day moving average. FOMC meeting minutes, how the rest of the Federal Reserve governors are feeling is going to be important to the market. Thursday or Wednesday night, let's just call it Wednesday night, Thursday morning in Australia, we have Australia employment. Again, double top, possible breakdown. And then we have the New Zealand RBNZ statement of intent. Basically, that's like it's crazy, like a 3-year outlook from the Bank of Japan, RBNZ. That's great and all, as you guys hear me say and have heard me say for literally years, I have a hard time figuring out what's going to happen 15 minutes from now, let alone what's going to happen like a month from now or a week from now or 3 years. I don't know how these guys forecast it, but that's why they are governors at the RBNZ and the Fed, and God bless them. How important that's going to be on Thursday morning or Wednesday night, we'll see. One of the other things that's happening early Thursday morning, Thursday morning if you're in Europe, is going to be the Norges Central Bank. They are expected to hike rates to 4%. So what gives with the Norwegian krona weakness? I don't know, but we've had a lot of discussions this week on how weak the Norwegian krona is, despite the strength that we've seen in crude oil this last week. And so that needs our attention, because really, and I'm just going to make this real simple for you guys, we start getting back above like the 1050 level, that's the 50 DMA. you know, you can read the analysis here because we do analysis on the Norwegian krona every day. Here, let me just see if I can find it for you. There it is. You know, we sit here and go, you know, above the 200-day moving average, it negates the bear flag. We had a bear flag, and we were holding that 200-day moving average. You can see it right here. Whoops. Here, let's do it that way. And now it's like negated, and this was a bear flag, right? It's negated, and we did like a real quick move up, squeeze to the 50 DMA. It's going to really ruin a lot of Norwegian krona traders' lives here if we start getting above that 50 DMA and we start breaking above 1050. And if the Norges Central Bank on Thursday just, you know, maybe they do a dovish hike, maybe they do hike as the market expects, and it's a dovish hike. That could send the US dollar Norwegian krona a lot higher, back up towards 11. Something to be paying attention to. We also have US unemployment claims, Philly Fed manufacturing. Then Friday, early morning out of the UK, we have UK retail sales. Again, all this UK data is going to be really important as we head into this week because of the GDP numbers of last week and really the unresponsiveness for bulls in the sterling. That is mind-boggling to me. It really is. Okay, so what I'm going to do from here, I want to go into the indices. I want to talk a little bit about precious metals. But if you like this video and you find it's important and beneficial to you every single week, please give my team a thumbs up. Jump in the comments below if I miss something, because I don't catch everything. I try to do, catch everything for you, but there are things that I'm going to miss, undoubtedly. And it's the weekend. You got to give me a break. So if there is, jump in the comments below. Let me know and let us know. And if there's something that you'd want covered, let us know there too. I can get into the nitty gritty details technically of some of that stuff as well. So let's go into the indices. I want to talk a little bit about them. I'm going to start off in talking about some of the non-U.S. markets, because if you look at let's go over to the BOJ, excuse me. Let's go over to the Nikkei. Where is it? I have it around here somewhere. Let me just find it for you. I just skipped over. Okay, here's the Nikkei. Notice the Nikkei is at range lows. Now, if for some reason, or range bottom, I should say, if for some reason we start getting the BOJ or Ministry of Finance checking rates, and if they start saying, "Hey, you're getting close to intervention levels with the yen," we could very easily see the Nikkei break below the support. So just keep that in mind. It's not something that we have to bet on. It's just something that if that happens, there's a little bit of a downside right to the breakout point, right? So it's something that I think you should be paying attention to. Also, if you take a look at the German DAX, the German DAX failed at new highs once again. We talk about this every week. We came down to a pretty big pivot, I think. It's been holding us. Now, if we start breaking below there, remember, we're coming out of a wedge. We start breaking below there, the support's 15,700. That puts the 200-day moving average at risk. And if we break below the 200-day moving average, that could get really kind of squirrely because you're coming out of an ascending wedge, a failed breakout at all-time highs. That could elicit some selling, right? It really could. So there's the German DAX. Let's take a look at some of the U.S. equity markets. Namely, we'll start with the S&P. The S&P, obviously, I follow it very carefully. I think I have a couple of charts here with the S&P. Let me see. Is this the one that we do every week? That doesn't really matter. They both look exactly the same. What do you notice? We are at the 50 DMA, right? I can get rid of this fib. That doesn't really matter right now. We're at the 50 DMA, and you can see it's clearly at a breakout point. And notice how we held, right? Long-term channel, held the channel, came off, held the 50 DMA, held the breakout point. So what does that mean? Well, I'll tell you what it means to me. It means that if we break the lows from last week, which would be basically Friday's lows, that is going to usher in some more selling. And probably we'd see a move back down to 43.20, which will be this blue line right here. Does that mean the trend has changed? No, I mean, we're pulling back in an ascending channel. You know, if you think about it, like just think about this. Let me grab my drawing tool here. Give me 1 second here. It is right here. No, 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 it is right. Where the hell is it? Oh, there it is. It's right there. Okay. If you think about it, we're in an ascending channel. If we break through 40, let's just call it the 50 DMA, we break that, we start clearing 44 and a quarter. We trade down to 43.20, right? Over time. Now we're getting towards the end of summer, right? You're starting to find some buyers. At the same time, the ascending channel continues, right? We all know that 4,200 is the key breakout point. So it wouldn't surprise me if we broke through that, hit 4,200, and then buyers stepped in for a fall rally. Why couldn't we do that and keep the bullish trend intact? Now, obviously, what would derail this bullish trend would be a recession. And that's really comes down to the debate at the end of the year. There are people that believe that we will be in a recession by the end of this year in the US. There are people that believe we have skirted a recession. There are people that believe that they'd rather just see it to believe it. But I will tell you, if we do get into a recession, which I think seems like the more likely outcome based on, following 12, 13 years of monetary policy expansion, balance sheet expansions globally for not only the Fed, but every other central bank, that we're probably going to have a hangover or in a recession sometime, this year or next year. If that is the case, when that happens, if it does happen, stocks tend to respond poorly in a recessionary environment. So that would mean that we might actually reverse. But we got to see the data. Show me the data. Right, exactly. So anyway, there's the S&P. I just wanted to point that out. Let's go ahead and take a look at some of the other U.S. equities. Here's the NASDAQ. Actually, I think there's a better chart here. Maybe not. NASDAQ 100. We are... Oh no, this is the NASDAQ versus the S&P. Sorry, this is the NASDAQ 100. We gave us a false breakout at the 161% extension. We are below the 50 DMA. That is a bit of a risk for the markets. The Dow, although, is holding up very well. Remember, this is rotation. You come out of NASDAQ heavy stocks, you rotate into some of the bigger cap names. That's still happening. But the Russell 2000, as we talked about last week, double top. We finally broke this support that we talked about last week on the week ahead video. Go back and look. We're now at the 50 DMA. We're closing in on it. A break below that opens up the next move to the 200 DMA, right down here. So if we continue to see like the heartbeat of the U.S. equity markets being the Russell 2000 play into some downside, it could weigh on the rest of the market as well. So remember, it's not just the Dow. It's not just the S&P. It's not just the NASDAQ or the Russell 2000. All these indices, they tend to play into each other. All right, so and I think what we need to pay attention to is to figure out is it rotation or is it straight up, I'm getting the hell out. And if it's straight up, I'm getting the hell out, and you see every index fall, that means the dollar is probably strengthening as people say, get me out of stocks, put me into cash. Get me out of stocks, put me into just cash. That's when all indices are falling together, and that we haven't really seen that yet, but that is a risk. All right, so last thing I want to cover, and don't hate me, guys. I know there's a lot of long-term, precious metal bulls. Look, I am one too. Gold looks vulnerable. Silver looks vulnerable. I think that they can't rally, and they haven't been able to rally. We broke back below 1935. If we start breaking below the 200 DMA in gold once again, it could open up a move towards, this range, this longer term range you see here. We can end up, making our way down towards the lower end of our range, maybe down into the 1700 somewhere. So watch gold. I think it's going to be very sketchy. We get below the 200-day moving average. Now, remember, gold and the dollar have an inverse relationship a lot of times, especially you got to figure out why gold's moving higher. Is it moving higher because there's geopolitical risks, or is it moving higher because of yields, or lower because of yields, or is it because of the dollar? At this time, gold and the dollar tend to have a very inverse relationship. So if the dollar continues to rally, that could put some downside pressure on gold. Now, do I think that gold is a buy somewhere down here? Yeah, I do. I actually think we're playing into this range. But, you know, how far it goes and, you know, where it goes, we'll see. I mean, we'll see. But you can see that silver also has broken, and it's broken actually this ascending trend line. You can see it here. And I'm looking at it as a Gartley, just so you all know. Gartley pattern would look just like this, right? Let me just draw it out for you. So that would take us somewhere around 20. I didn't draw that correctly. Let me get it to somewhere, something like that, right? The risk is, though, we start breaking below 20, and you're going to start to see some longer term silver longs liquidate. Now, would I be a buyer on dips? Absolutely. Do I think we're still going to dip? Yeah, I do. You know, will I be wrong? Who knows? But I would think that as you approach 20 in silver, as gold approaches the 1700 handle, you know, whether it's just below 1800 or somewhere down in that neighborhood, I think offers some great opportunities for longs. But we're not there yet, and there's still a lot of time before we get there, even if we do. So we'll be paying attention to that in the weeks and months ahead as we head into the second half, or continue into the second half of 2023. Anyway, guys and gals, I think I've been with you long enough on this week ahead video. If you liked it, please like, share the video, subscribe to the video. And I just want to say thank you for hanging out with me. I know your time is very important. I appreciate each and every one of you. Have a great rest of your weekend. I will see you on the Monday Face Show, first thing Monday morning. Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.